Now, as we pivot to the consumer, we want to start off with core PCE inflation. And here you can see that the survey was for 0.2, the actual was for 0.1. Everybody was like, rah, rah, look at how good things are. But remember, September wasn't good in terms of the increase in pricing. You had a huge increase in oil prices, energy pricing. And it takes time, especially with the way the PCE is calculated. It takes a little bit longer for that to really get priced into the same degree. And one of the things that we talked about on the PC inflation side is things flatlined and then are going to start to reaccelerate. And this is a bit lagging when you look at the impacts. So while it fell below the survey, and you might say, it's like, well, the Fed's going to look at this positively. It's like, well, where are we going forward though? You're seeing more pressure. You've seen home prices pick back up. You've seen energy prices pick back up. You've seen service prices pick back up. All of those are going to have a negative or at least a positive impact in terms of where inflation is going, and that's going to keep them on the sidelines. Core services, less housing. Again, because there's that lag in housing, so they're still pricing in that reduction in housing, which we know has gone away, but it still hasn't fully priced into the system just based on the way this is calculated. But if you look at that reacceleration, these are things that are going to keep the Fed on the sidelines, keep yield rates higher, which is going to, again, cause much bigger issues at small businesses, other businesses, and keep the consumer reduced. U.S. real personal spending came in at $15.48 trillion. U.S. real disposable personal income, you can see kind of rolling back over. It's important to see it's still above where we were in 2019. So when you look at 2019 and today on the U.S. real disposable personal income, it's still higher. So people act like the world is ending, and it's like, well, this is why we're going to have this massive hard landing. And don't get me wrong, you're not speaking to someone who is bullish, but I'm also not a doom and gloom guy. Like, there is still excess out there. There's still something to be said about where the consumer sits, the personal income they're sitting on. Yes, rates have gone up. Credit card expenses have gone up. You're going to see a contraction, but it's not going to be something where it's an all stop, world is coming to an end, service, then the economy drops by 8-10%. It's going to be gradual and then painfully slow to recover, because there's going to be this perpetual issue when you look at the leverage ratios, when you look at consumer debt, that's going to keep people on the sidelines. If you left the workforce due to lack of childcare options during the beginning of the pandemic, are you still out of work? Yes, I'm still out of the workforce is at 28%. Yes, I'm still out of the workforce, but is at 23%, is at 17%. No, I'm back in the workforce. And so you're seeing some of these pivots and with the childcare side, but yet you're still seeing that latency component that we talked about in the previous segment, where childcare is not to the same degree. You're still seeing less children in childcare because of the cost. And so even as people may have gone back, is it full-time or part-time? And that's where you're starting to see some of these shifts due to the lack of childcare. Then retail inventories survey was for 0.5, came in at 1.1%. U.S. retail inventories nominal, you can see the big spike. But then when you look at real, we are now well above 2019 levels and getting worse. And this is, again, why we saw the much bigger impact to ASEAN nations, and why we've seen that trade slow down is because companies, especially in the U.S., are sitting on more and more inventory because you're seeing that slowdown in spending. You're seeing that slowdown in activity. So why am I going to order new stuff? Our view was that the ASEAN side was going to be a bit more gradual. Instead, it was a bit more of that all at once, which is a much bigger problem in general. Factory orders starting to turn the corner year on year, up 0.5%. And this is what we were saying. You're going to get to a point, and then you're going to kind of flatline. But as inventories build, we will get another leg down. It doesn't happen all at once. People still need inventory. They still need to have stuff on the shelves. And that balancing act is happening on the retail side. It takes time to have that essentially, flow backwards into the manufacturing wholesale market, which is where we see a bit of a bigger hit. University of Michigan Consumer Sentiment Index, previous estimates for 67.7, came in at 68.1. Consumer expectations expected at 66.4, came in at 66. So again, the consumer's kind of like blah. They're kind of sitting here saying it's not great, it's not terrible. And that's where it's like, that's why you see kind of spending where it is, where it's not rolling over completely, but it's also not going up, but it's also not collapsing. ISM Manufacturing PMI was expected at 47.9, came in at 49. New orders expected at 47.8, came in at 49.2. So remember, we said that it was going to get to a point, but then you were going to get that flat line. Then you were going to get a nice little pivot higher, but wasn't going to go into expansion. It was going to stay in contraction, but not at the level it was. And that's where we are. Like now we're going to, in our opinion, it won't continue to go higher. It'll start to come down again. And you're going to get this balancing act, which we think continues to play out here. ISM Manufacturing backlog of orders. And again, back to why we think this is a likely reduction. Here you can see backlog of orders declined, came in at 42.4. So we had a strong increase of backlog of orders, still in contraction, but a bounce off the bottom. So then we got that nice bounce. Now they're rolling over. And again, you're going to see that pull back on the manufacturing front. Prices paid expected at 49, came in at 43.8. Again, showing that slowdown, that reduction, which is what we think is going to be likely. Spread between ISM Manufacturing new orders and production stayed in negative territory in September, consistent with the broader disinflationary trend. But remember, manufacturing is a much smaller component versus services, and services actually went higher. It was the opposite of this, which again continues to be some of the pressure points and the issues that we continue to see. August JOLTS job openings came in at 9.61 versus the estimate of 8.82. So again, you're seeing some of this balancing out, but the JOLTS quit rate unchanged in August, still down considerably, but you get an idea of just how elevated they are. And if you look at the Fed's mandates of inflation and labor, well, labor's still elevated and inflation is picking back up. So where are we going to see a cut? And if anything, looking at labor, looking at inflation, likely see one more rate hike, which is what we think things are being priced in. Personal interest payments are climbing rapidly as a share of personal income, 4.2% share, not extreme relative to history, but in the upper end of the range, and now back to where it was in mid-2008. And this is what we're talking about as impacting personal bankruptcies. Because again, even though, yes, you can afford your mortgage, that is not an issue because you have such a low rate. But can you afford the lifestyle you're leading? Whether it's car payments, whether it's, going out to eat 3 times a week. These are the things that compound over time and create a much bigger problem. August personal income expected at 0.4, came in at 0.4. Personal spending expected at 0.5, came in at 0.4. So again, but when you adjust it for real, as we did in the previous segment, you're still negative. And you've been negative now for 3 months. Which is why it's important to look at not only just the nominal, but also the real side. And that's why we're seeing interest payments increase personally, because people are seeing their real spending go down, their real income go down, and relying more on that credit. So then when we start looking at the Kansas City side in terms of those leading indicators, given new orders sank and remain in contraction while employment stayed in expansion, but the bigger issue for us is new orders, which is a pivotal key leading indicator, which you can see had a sizable drop. Even when it bounced, as we said it would, it stayed in contraction, and now you're starting to see that pare back, which is a much bigger issue when you're thinking about future growth. Bounce in prices paid component within manufacturing has confirmed similar moves in other regional Fed PMs. September manufacturing index came in at -8 versus -2. New orders, shipments, production all sank. Prices paid eased lower. But when you look at some of the key pieces, manufacturing index, when you look at the prices paid, some of it went up and some of it went down depending on where you are. But net, you had a reduction in some of the pricing. Now, the regional guys are ahead of the national. So the national manufacturing prices paid declined, but here you see a bit of an acceleration because it's a matter of when are the energy costs, the diesel, starting to get rolled in, and it starts to get rolled in here. So again, that reacceleration, that push back higher, we were expecting to start to see more stagflation leading into deflation starting in Q1 of next year. Instead, we've seen a reacceleration of inflation, which again, we kind of pivoted our view back in July. I should say back in June. So it isn't surprising for us. But when we looked at the market back in April and May, right now, if we didn't change our view, we'd be dead wrong, because inflation's going up, not down, because we expected kind of this big spike in inflation, stagflation, and then deflation starting in Q1. But as that inflation reaccelerated, all of that gets pushed out. And again, more of that pain continues to get priced into and pushed into next year. August PC inflation came in at 0.4. Core came in at 0.1, smallest monthly gain. But you get an idea that there's a certain amount of catch up. And that's where the core got slightly better, but the top line got worse. And then when you look at the levels going back to the 1990s, you can still see, even though it's come down, you're still at some of the highest it's ever been, which is, and while that being the case, you're actually getting a reacceleration, which the consumer is feeling. That is a pain point. That is a huge issue. And for the talking heads out there that say, oh, well, year on year is showing that we've gotten in front of this. It's like, who pays on things year on year? Like, do you go to the grocery store and say, well, year on year, we're only up 2%. Therefore, I'm not going to pay your 19% increase. No, it's a pain point that is compounding on itself. Then when you start looking at manufacturing orders, they came in at 1.2% versus the estimate of 0.3. X transports came in at 1.4 versus 0.2. So again, that balancing act, you had a big move down in June. Now you have a big move up. These are always very lumpy. So it's something where it's not really showing a bigger trend change, but just trying to manage. Now on the service front, ISM services came in at 53.6 versus the estimate of 53.5. Prior was 54.5, so it slowed. New orders fell to 51.8 versus 57.5. Prices paid unchanged at that elevated 59. Business activity rose. Supplier delivery is a bit higher. So new orders is the key piece, is because it's still an expansion. So again, we're not saying that the economy is collapsing, but it's slowing. That is a big warning signal, because services is such a big part of the economy. That slowdown in new orders is, again, supporting our view that the reduction is here. Prices paid, as you can see, kind of staying at that elevated level, that reacceleration, the things that the Fed wants to get in front of. Manufacturing came in at, as we said, the 49 versus 47.9. New orders, again, right there, given prices paid and supplier delivery component in manufacturing turning lower. Supply and inflation-related stress hasn't made a marked comeback, but you're starting to see that change when you look at the regional Fed. Not that it's just massive inflationary push, but it's just the benefit or that reduction against services is depleting, which is going to push that total inflation number higher. 3-month annualized change in PCE core service ex housing eased to 3.4%, nowhere near peak, but again, still very high, especially when you go back through the previous years. Different weightings of components for core services and PCE. Former had dramatic swings, but as you can see here, when you look at the core service less housing, that stickiness remains, and this has been our fundamental foundational view that this was going to be the case. Personal annualized basis core PC inflation eased in August, but again, looking at the yellow, you can see that big drop, but look at that blue line, that acceleration that continues to be here. That's what you feel at the cash register. What the talking heads look at is the yellow line, but what you're actually swiping your credit card to buy is the blue line, which is, again, that disconnect in terms of reality. And then when we start looking at, again, government transfer payments, made up 17.3% of personal income, lowest share in the post-pandemic era. Personal savings rate continued to drift lower in August, not in extreme, but again, still trending in the wrong direction as people pull out of savings, increase credit card payments to maintain lifestyles. August construction spending came in at 0.5 versus the estimates. Private residential home improvement came in at negative 0.7, which is important because that's kind of like the tipping point on that bigger reduction in housing demand. August pending home sales came in at negative 7.1% month on month versus the estimate of negative 1. Worst month since September 2022, taking overall level down to the lowest since April of 2020. Freddie Mac multifamily serious delinquency rate increasing to 0.25%, and the rate of change is going up. And again, this is showing that stress, that pending home sales, you're having more cancellations. And a lot of that is driven based on the Case-Shiller home price index starting to turn back up, as interest rates for optimal blue 30-year conforming fixed rate at 7.6%, pushing U.S. housing affordability to the lowest it has been in going back to the 70s at this point. So then when we start looking at this a different way, given recent weakness in pending home sales, year-on-year trends starting to hook lower again, still in double-digit decline. But again, you could see nothing dies in a straight line, which is what we were saying. It's, look, you'll get a bounce. Seasonally speaking, you should have a bounce. Home buying season is the summer, and our point is that the slowdown is going to be even bigger as we go into that lull because there's not as much buying, there's not as much demand. U.S. pending home sales index has now fallen by 44%, but again, you got to put that into context. Strong run from 21 to 22 in residential home improvement spending over for now. Some adjustments, but you're getting, again, that slowdown with pending home sales in the South struggled the most, falling 9.1%. Now, for those that have been following the news, the South was the strong point, and the South has now started to give up the ghost. You're starting to see that slowdown, and that is a much bigger issue in terms of where some of these flows are going to go and why we think that housing market is going to roll over much sooner than I think people think, especially when you look at mortgage purchase index has fallen again to the lowest level since 1995. And a lot of that is the 30-year mortgage rate settling into the range, evidenced by the pace year on year. And as you can see, it's pushing back up as we're now closer to 7.6% and likely going to hit 8% before the year is out. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and the issues that continue to arise in Europe and how the data continues to get worse and show and really confirm how that recessionary bite is taking hold.